Assalamu alaikum class. Today's lecture is about treasury stocks and its impacts on shareholders' equity. So, what is treasury stock? It is defined as the shares of a corporation's own capital stock that have been issued and later reacquired by the company, but that have not been cancelled or permanently retired. So, Treasury shares may be held indefinitely or may be issued again in at any time. So, we will practice how these Treasury stocks are reacquired and then issued, and then its impact on the stockholder equity. So, shares of capital stock are held in treasury stocks are you can say it has no dividend rights and no voting power or no share in the assets upon dissolution or liquidation of a company. So, about treatment, you can say the repurchase is recorded on the company's balance sheet as a reduction in equity. So, that's why it is also called contra equity accounts because it reduces the equity portion in a balance sheet. So, it represents cash spent by the company to buy back its shares. There may be several reasons the company might repurchase its own stock. Like, for example, the company wants to increase the value of remaining shares by reducing the total supply in the market. Another reason maybe is to distribute excess cash to shareholders when the other investment opportunities are limited. And one more reason that in order to prevent hostile takeovers, the sometime company reduce the number of shares available in the market for outsiders. And one more possible reason is that the company may use it for employees compensation plans, for example, stock options or bonuses. So here you can see it is the stockholder equity portion. We have contributed capital, and in contributed capital, we have preferred stock, common stock, and excess of par value. And then we have retained earnings. So we add contributed capital with retained earning, and then we deduct treasury stock because it is the buyback of the shares or repurchase of the shares. That's why it is called contra equity account. So let's begin with some practice questions from Financial and Managerial Accounting book written by William Zaka Bettner, and we are discussing chapter 11. And here you have a brief exercise 11.9. So let's start with the discussion that the company originally sold. Here you can see 100,000 share of $10 par value of common stock at $25 per share. So par value is 10, 25 is the market value. So value in excess of par is $15. Or you simply can say that the premium is $15 on common shareholders. Several years later, the company repurchased 10,000 of these shares at $55 per share. So the company holds those shares in treasury, prepare a stockholders equity section of the balance sheet to reflect this information. So now we are going to prepare a stockholder equity portion. And stockholder equity portion, we have common share, or you can say we have contributed capital. So in contributed, first of all, we calculate contributed capital. In contributed capital, we have common stock, for which we have 100,000 shares at the rate one share amount is $10. This is par value. So $10 is the par value. So the total amount is here 100,000 is the number of shares multiplied by par value. So this is the total common stock. And then we have additional paid in capital. Additional paid in capital is simply the premium on the shares. So premium, here we have 100,000 shares, and at the rate, 10 is the par value and market value is 25. So when we deduct 10 from 25, we get 15. So 15 is the excess value, or you can say it is the premium. So we have 100,000 multiplied by premium, which is 15. So we are going to add it. So 2.5 million or $2,500,000 is your total paid uh, paid in total, you can say contributed capital, because we do not have any retained earnings. So this is contributed capital. This is the total amount, and then we will deduct share repurchase there. So we will deduct treasury stock. So 10,000 number of shares are here, and one share's value is $55. So here we have at the rate. So amount is 10,000 number of shares multiplied by one share is for $55. So now we are going to deduct it. So this is the total stockholder equity amount. That's why this treasury stock is called contra equity account. So we have total stockholders equity. So this is your final answer. We have calculated total stockholder equity. So here this amount is also in dollars. So that's it from this exercise 11.9. Then we are going to move toward 11.10. So here, this is our next exercise, 11.10. And in this, we have 100,000, or you can say 1 million shares, $25 par value, and it is sold as 30 at $30, which means that if par value is 25 and market value is 30, this means that the difference between these two amount is $5, which is your additional paid in capital, or you can say in simple word, this is the premium. So in subsequently it subsequently repurchased $100,000 of those share at the rate of 50, and then sold 70,000 from these 100,000. They have sold 70,000, and the selling price is $55. So the difference between 50 and 55 is again $5, which you can say here additional paid in capital for treasury stock. So what is required? The total amount of stockholder equity, or you can say stockholder equity portion. So what we are going to do is we have first of all we have mm, um, contributed capital. So In common stock, we have common stock amount is 1 million shares at the rate par value. So par value is 25. It is so dollar 25. So here we have 1 million multiply by 25. So all amounts are in dollars. Then we have additional paid in capital. Additional paid in capital on 1 million shares is $5 at the rate $5. How this we have calculated this $5 because market value is 30 and par value is 25, so the difference is $5. So 1 million multiply by 5. So this is your additional paid in capital on the common stock. Then the company repurchased 100,000 shares, out of which the company sold again 70,000. So this 70,000 is already included in this 1 million shares, but additional paid in capital, which is $5, is not here. So we have additional paid in capital, but this is on treasury stock. And how we are going to calculate how many shares the company resold? Total 70,000. 70,000 shares, and the amount of additional paid in capital is $5. So here we have 70,000 shares at the rate $5. So this is your additional paid in capital on treasury stock. So when we add all of this, we get subtotal in the treasury, in the you can say stockholder amount, total stockholder amount. Then at last we will deduct. Here we have one, this part, and then we will deduct treasury stock. We have just discussed the definition of treasury stock, that the number of shares the company repurchased. So, company repurchased 100,000, out of which the company sold again 70,000. So, how many shares are remaining in the repurchase? The remaining shares are 30,000, because the company has sold again 70,000. So 30,000 shares at the rate, the amount of one share is, you can see, $50. So here we have $50. So we can calculate it in this way, that 30,000 multiply by $50. So we have 1.5 billion, and we will deduct it from the subtotal in order to get total stockholder equity account. So here we have this amount, 28.850 million dollars. So this is called your total stockholders equity. So this is the requirement. The next problem which we are going to complete in this lecture is exercise number 11.9. which is also about treasury stock. So let's begin. 11.9 problem. Here it is 11.9. So the company engaged in the following transaction involving treasury stock. We have Feb, June, and December. Three transactions are there. Number one requirement is to prepare journal entries to record these transactions. So first requirement is to record the transactions. We have a date column, then accounts titles, then we have a debit column and a credit column for recording of the journal entries. So the first entry is on Feb 10. The entry is purchase for cash 17,000 shares of treasury stock at a price of $25 per share. So company buyback shares. So we have now we are going to debit treasury stock, and the company paid cash. How much cash was involved? Simply you can say 17,000 shares, and one share is for 25. So the amount is 425,000. So again, 17,000 shares, and one share is um, for $25. So here all these amounts will be in the dollar column. So this was the first entry. The second entry is on June 4th. So we have June 4, and the entry is about reissued 6,000 share of treasury stock at a price of 33. So price of 33, the company reissued. So now, the as the company repurchased 70,000 shares, 17,000 shares, out of which the company reissued 6,000. So now this treasury stock is going to be decreased. So whenever the company reissued, the company get cash. So then treasury stock will be reduced, and then the company also get you can say additional paid in capital. So this would be the entry, and how we are going to calculate amount. 33. So because the par value or original value, the company purchased treasury stock for 25. So 25 would be the value at which the company purchased the share, uh, or repurchase the share. So the difference between 25 and 33 is $8. So this $8 represent additional paid in capital. So how many shares are there? 6,000 shares multiplied by the difference between 33 and 25, which is $8. So this $8 represents uh, additional paid in capital, whereas treasury stock is 6,000 number of shares multiplied by one shares. Par value is 25, so we multiply it by 25, which is 150,000. And now cash, we are going to uh, debit cash, which is 6,000 shares, and company sold it for 33, so which is $198,000. Or you can simply add these two credit amount to get debit amount. So both way are okay. Whereas in requirement number or entry number 3 is about December 22, and the company reissued 4,000 share of treasury stock at a price of $22 per share. Now you can see the company, the original, or you can say the par value is 25, and company sold treasury stock below par value. The difference is $3. So now the additional paid in capital is going to be decreased. So the company received cash. How much company received cash? Company sold 4,000 share at the rate one share is for 22. So here the company got 88,000. And then company sold treasury stock. So treasury stock will be on the credit side. How much the company sold it for $22. So the book value or the par value or the face value is 25. So here 4,000 multiply by 25. So this is the treasury stock on par value. And then because the difference between 25 and 22 is $3, which is discount, or this $3 is basically reduction in additional paid in capital, paid in paid in capital. And how we are going to calculate? 4,000 number of shares are issued, and the amount, the difference between these two is $3. So here you can see the debit and the credit side are equal. So these are these three requirements. The requirement number B is to compute the amount of retained earnings that should be restricted because of the treasury stock still owned at December 31st. So you can say that the company is still owing total 17,000 was the treasury stock. So the company reissued 10,000 shares, 6,000 on June 4 and 4,000 on December 22nd. So total out of these 17,000, the company reissued or resold this 10,000. So remaining is 7,000 shares. So this 7,000 shares, you can say 7,000 shares multiplied by par value is 25. So the answer of part B is total dollar 175,000 is the amount that is, you can say, is the restriction of retained earnings for treasury stock owned at the year end. So this because this 7,000 is still unsold. And what is the requirement number next? Requirement number next is, does a restriction on retained earnings affect the dollar amount of retained earnings reported in the balance sheet? So the answer is, simple answer is no. Why? Because a restriction of retained earnings does not affect the amount or the total amount of retained earnings reported in the balance sheet. So a restriction on retained earnings is disclosed but does not reduce the amount of retained earning of a company. So this restriction on retained earnings simply limits the amount of dividends the corporation can pay as long as it holds treasury stock. We have already discussed in very start of this lecture that you can say that treasury for the number of the shares which are in treasury stocks, they are not entitled to get any dividends. So that's why it is not going to simply affect retained earnings. So that's it for this lecture. Take care, class.